Thanks for checking out this video. My name's Miles Pitcher. I own Superior Lending. I've been in the business 23 plus years. As I talk to clients many times, especially those who are first-time home buyers, they haven't bought a home yet. Many times the initial conversation, they say something like, I don't think I'll qualify, or I'm not ready to buy a home yet. So my purpose today is to walk you through a few checks that you can evaluate and say, am I mortgage ready? There was a study done by Freddie Mac. Freddie Mac is one of the semi-government agencies that guarantees our conventional loans. The other is Fannie Mae. And they did a study that they came out and said 41.1 million people are mortgage ready. I actually believe that number is higher. They also said 13.3 million people are near mortgage ready. And I'll help you understand the difference between those two. But I think they were very narrow in determining who fit in that box. I believe the number is well above, taking what they've estimated and expanding it a little bit, 54.4 million people. And they specifically are identifying people who haven't bought a home yet and they're under the age of 45. So that's a lot of people. So let's start looking through this. Some of the common challenges or concerns we run into with our clients is down payment, just understanding how a mortgage works, what it takes, what does it look like. A lot of people are turning to family, friends for financial literacy, the internet. I mean, you're watching this video. I highly recommend that you talk to a loan officer and really get it straight on this literacy part of things of getting a mortgage and buying a home. Student loans are a big deal right now. I've had a lot of clients who have said, I won't qualify because of my student loans. Well, if you feel like you're in that spot, please give us a call. We can help you, guide you through how to maneuver the student loans and still be able to get into a home. And then just being comfortable with the monthly payment. In that also includes the rise in interest rates we've recently had and where home prices have risen also. We love getting strategic with our clients in helping in figuring out how to have a comfortable monthly payment. So when I look at mortgage ready, there's really a few categories: credit score, down payment, debt ratio, and we'll talk about what that means. It in more depth, it basically means what percentage of your income is going to pay your new mortgage payment and other monthly debts that you have. Monthly payment is the last one I put on there. It's part of the qualifying, but I have a different spin on it or a different view of it that I think is super important. So credit score, according to Freddie Mac, they said if for you to be mortgage ready, you had to have a 660 or higher, 661 or higher credit score. We are frequently helping clients who have 580 or higher credit scores and still fit into a traditional mortgage. FHA loans are very, very flexible in that area. So I'm going to put up a link to a video that will give you some tips on how to boost your credit score, but just know that you're in the game if you have a 580 or higher. And if you don't know where your credit score is, please give us a call. We can do a soft credit pull so it doesn't hurt your score, and then you'll know where you're sitting on there. And we can give you some advice on how to improve those scores. Obviously, the higher the score, the better the interest rate you're going to get, the better the monthly payment you will get. So credit score check, 580 or higher. Let's talk about down payment. So there is a big misconception out there that you need 20% down payment to get into a home. This is absolutely not true. In fact, most of our clients, you can see here, first-time home buyers on average are doing 6%. If you take the whole viewpoint of all home buyers, not just first-time home buyers, it's at 14%. And those people who are move-up home buyers, they're doing 17% down payment on average. The truth is, you can get into a home with 0 to 3.5% down payment. Um, so what can we do for those who don't have down payment? Well, there are down payment assistance programs, and there are different variations of these: grants, loans, forgivable loans, and tax credits. Okay. And there's just a whole slew of these. We actually have a database that we have access to, and we would love to be able to show you what's available to you. Here's the questions that we need answered and to be able to say, you may qualify for this type of down payment assistance. So just real quick, address of property, okay? How many people are in your household? How do you currently own a home or not? How much is the total gross income for everybody in your household that's 18 and older? So if you, husband and wife, have a daughter that's 18 years old working a part-time job, we're going to include that income in the household income. Do you have VA eligibility? Are you a veteran? Some other ones, there are great loans for American Indians, if you or your co-borrower are. And then in these areas or professions, education, law enforcement, firefighter, healthcare, there are some great incentives or loan products for these there. So just reach out to us, answer these questions for you, and we can quickly point you to what's available. All right, so down payment, we've got that taken care of. And I will mention also, down payment, we are seeing more and more people using gift funds from relatives and being able to get into homes, and it's actually a brilliant way to do it. Or if you have a 401k, you can take a loan. You're basically taking a loan from yourself out of your 401k to be able to get that down payment. Let's talk about debt ratios. This is one of the most important pieces here. So we call it DTI, debt to income ratio, and sometimes you'll hear front end, back end. The big one that we really get concerned about is the back end debt ratio. And let me explain and walk you through what that means. So we look at your monthly debt payments, and we're going to include what that new mortgage payment on that new home is. We'll take your minimum monthly payment on your credit cards, car loans, student loans, or any other debts that you may have. And we total those all up. We then divide that by your gross monthly income, or what your pre-tax take home is per month. We divide those and we end up with a ratio. And let me give you an example here. Let's say that your new mortgage is going to be $2,000 a month. You have a $300 a month car payment, and you're paying about $200 a month in your credit card minimum payment. You may be paying extra, but we go off the minimum payment. You make $10,000 a month gross, so $120,000 a year is your salary. We divide that $2,500 into the $10,000, and we come up with a debt ratio of 25%. That's a really good debt ratio. What can we go up to? Well, Freddie and Fannie on conventional loans will be somewhere between 45 to 49%. FHA is phenomenal in that we can usually go up to 56% for our clients, okay? There's other things that factor into it because it's not just that debt ratio, but it's all about down payment, your credit score, and then also that debt ratio. But that is a great way. So you can kind of run the numbers, or we're happy to do it for you to see if you fit for the debt ratios. If you're commissioned, self-employed, we really need to talk to you because there's a lot of nuances in qualifying or figuring out your debt ratios based on those. I want to talk about monthly payment now, okay? So many times I have clients who qualify for quite a bit of home, a large monthly payment, but they're very uncomfortable with that maximum payment. So I always ask my clients, where do you want to be on your monthly payment? And I ask them to put that number, obviously the lower the better, but where is that comfort level that makes you just a little bit uncomfortable? You can totally make it and totally do it. I want to know what that number is because I want you moving into your home and not feeling house poor. I want you comfortable with that payment. I always recommend to my clients they have a budget, right? And that's how they figure out what they're comfortable with on that monthly payment. And I always love to see them having built up an emergency fund. Dave Ramsey talks about these things a lot. I'm not always a fan of Dave Ramsey, but having that emergency fund for 3 to 6 months, I believe is super, super important. And it just gives you a comfort level as you move into this home. The other thing is clients oftentimes are used to having a landlord who takes care of all the maintenance on their homes that they are currently in. When you become the homeowner, you're going to pick up some additional expenses such as utilities, cable. There'll be things, maintenance. I just got done replacing a water heater. It was not cheap. You need to factor those in and be ready to handle those as you become a homeowner. And then also the HOA expenses are sometimes people don't factor those in their budget. We do in our calculations, but I just want you not feeling house poor when you move in. So if you look at those items, credit score, down payment, your debt ratios, and you're comfortable in the monthly payment, yeah, you are house mortgage ready. And I believe there are so many people out there that don't realize that they are. And we love helping these clients realize that and even get strategic in figuring out, is there a way to get that monthly payment, even with high interest rates, high home prices, to fit their budget? We're always available to help talk with you, your family, clients, realtors, and figuring these out. This is how you can get a hold of me. Scan that QR code right there for my business card, but please feel free to reach out. Thank you.